So yeah, good people, media mentor Tumelo JP here. Hope you guys are doing good, and welcome to a group session where we are going to be addressing the whole mentorship program, right? On today's session, we are going to be covering several chapters that are very important, and all I'm going to say to you guys is that okay, the concept is straightforward, it's simple. Make sure that you apply each and every single thing that I'm going to be teaching you here, right? Yeah, please make sure that if you have any problems, you can address them to me privately. If you want, you can address them in the group so that others can also be able to be assisted, right? So on today's session, we're obviously going to start with what? Introduction to structure, introduction to market structure. Introduction to market structure. So that's the first chapter that we are going to be dealing with today. Introduction to market structure. So it is very important for each and every single trader to be able to understand price structure, right? It is very important for everyone to be able to understand what price structure. Why? Because of this helps you to understand where price is from and where price is going, right? So if you do not know where price is from, it's always going to be difficult for you to anticipate or know where price will go after that, right? So make sure that you will invest your time in understanding, right? So if you feel like there are some things that you would want me to address, you thank me for me in the group, right? Okay, so let's get started. Let's get started. Okay. So introduction to market structure, right? A very complex chapter, very important. Teaches you about the introductory part of what market structure. So on the chapter of market structure, we are going to be talking about several things, right? We are going to be talking about several important things. Which is what you call a trend. Right? Which is what we refer to as what? As a trend, right? A trend. Right, trend. Introduction to a trend. Trends, actually. Okay. So on the chapter of introduction to trends, we firstly have to understand that there are several key important things that we have to deal with, right? So the first one is what we refer to as what? Trend properties and trend rules, right? Trend properties and trend rules. Right, trend properties and trend rules. Trend properties are the components that makes a trend, and then the rules, those are the instructions a trend needs to obey, right? Properties are the components that makes a trend, and then the rules, those are the instructions a trend needs to obey, which means a trend, for you to be able to identify it, you firstly start with what? The properties, and then you check if it is really obeying the rules, right? Okay, so we have two different types of trends that we're going to be talking about, right? So the first one is what we refer to as an uptrend. So an uptrend will be the first trend that you're going to be dealing with. Right? We're going to be dealing with an uptrend, and then secondly, our downtrend. Right? We're going to be talking about what? Our downtrend. Right? Downtrend will be the trend that we are also going to be talking about. Right? Right. Okay. So an uptrend occurs when price is pushing to the upside. Occurs when price is pushing to the upside, right? And then the trend properties. The trend property states that every time you're on an uptrend, you'll find yourself where you have what? Your higher highs. Have your higher highs and your higher lows. Right? And then the rule states that every time you're on an uptrend, you should break highs, which are your higher highs. Then you should not break lows, which is your higher low, right? So this is a typical example, right? This is a textbook uptrend, right? This is what a textbook uptrend. An uptrend occurs when prices push into the upside, creating a series of higher highs and high lows, breaking highs and not our lows, right? And then a downtrend occurs when prices push into the downside, when price is pushing to the downside. Yeah, when price is pushing to the downside, creating trend properties, right, of what? Lower low and lower high, right? And then the trend rules state that every time you're on an uptrend, price should always do what? Should always break lows, which are our lower lows and our lower high. I mean, should not break, should not break our lower high. Right. So this is, as I've been first out to you guys, this is a typical example of an uptrend, right? We are not really going to be addressing price like this, but this is what you need to know every time you think of what you think of trends actually, right? So an uptrend, it occurs when price is pushing to the upside, creating a series of higher highs and high lows, breaking highs and not our lows. A downtrend occurs when price is pushing to the downside, creating a series of lows and highs, which is our lower lows and lower highs, and breaking lows and not our highs. Right. So there's an uptrend, there's a downtrend. So for example, if you're on an uptrend, but and normal, like even if you go to the internet, you find an uptrend like this, the typical example of an uptrend, right? There's a higher high. That the lows will be what? Your high lows, right? And have your high lows here, and have your high lows here, and then you have your high low here, right? So those are the properties, right? Hence why we always start with our properties. And then our rule states that we should always eliminate our high, right? As you can see, our highs are always taken out. Our highs should always be taken out, but the low should always not be taken out, right? Hence why you see that price never broke this low, price never broke this low, price never broke this low. They always play above these levels here. They always play above those levels, right? So this is a typical example of what? Of an uptrend. Does it make sense? So when I ask, you can just type it on the chat so that I can know that I can continue the session. Does it make sense, guys? What is responding? So it means it makes sense. Okay, so moving on, a downtrend occurs when prices push into the downside, right? price is pushing to the downside. Right, when price is pushing to the downside. Right. So every time price is pushing to the downside, like I said, what is it that we normally start with? Our properties. Right. We'll see about our lower highs, not our high highs. Our lower highs, right? We'll start firstly by seeing our lower highs, our lower high, and then our lower high. Then here we're gonna have what? Our lower low, our lower low, and then here we have what? Our lower low. And then what comes after that is that, okay, you will go to the rule. The rule says that we should always break what? Always take our lows out. Hence why when we take our opportunities within these areas here, we normally target our lows, right? Our lows should always be the ones that are eliminated, right? And then this high was not taken out by that one. This high was not taken out by that one. Then this high should not be taken out by that one, which means our highs will forever be what we refer to as protected, right? They should always be protected, which means you don't want to see price taking them out. Okay. So that's about it on introduction to market structure. Then let's go to introduction to types of structures. So we have three different types of structures, right? So these structures are very, 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 very important, right? Why do we talk about types of structures? It is because of most traders fail to know what type of structure they are in, and then they end up taking wrong trading opportunities, right? They end up doing what? Taking wrong trading opportunities, right? Find that the overall direction of the market is bearish, but then on the bearish movement of price, you're looking for what? You're looking for you are looking for buying opportunities, right? So it's very essential for you guys to know the type of structure that you're in, right? So that you can be able to understand what opportunities are you supposed to look forward to from the market, right? So now, when we talk about introduction to market structure, we are having three different types of structures, which is what we refer to as a minor structure, yeah. And then we're gonna have a substructure there, right? Have a substructure. We're gonna have a substructure. And then here, what is it that we have? We have the swing structure. So here we have what? We have the swing structure, right? So a substructure, it's what we refer to as what? As our highs and lows, right? This is our highs and lows on both trends, right? Both trends meaning that uptrend and downtrend. Right? What does this mean? This means that every time you have your higher high on an uptrend plus your lower high on a downtrend, this is what we're going to be referring to as what? As our swing highs, right? And then every time you have a lower low plus a higher low on a downtrend and uptrend, we're going to call these things what? Swing lows, right? So this is a typical example of what? Of a swing. Sorry guys, this is a swing. I made a mistake. This is swing structure, right? And then a substructure. So a swing structure is when we refer to our highs and lows as swing highs and swing lows, right? For example, on an uptrend and downtrend, our higher highs and lower highs, right? Those are what we call swing high, and then our lower lows and higher lows, that's what we refer to as what? That's what we refer to as our swing lows. And then a substructure. A substructure is quite simple, right? This one occurs when price goes goes against the overall direction of the market. Right. This one occurs when price goes against the overall direction of the market. If price is going against the overall direction of the market, what does this mean? This means that every time you find yourself on an uptrend, you find yourself in a situation where you have what? A temporary sell, right? And then every time you're on a downtrend, as an overall direction of the market, you're going to find yourself in what? A temporary buy, right? It is famously known as what? As a correctional wave, right? It is famously known as a correctional wave, right? Or a pullback, or a retracement, right? That's what a substructure is. And then a minor structure has to differ from what? From a sub. So a minor structure, this one occurs when price is taking the overall direction of the market. Right, this one occurs when price is taking over the overall direction of the market. If price is taking the overall direction of the market, this means that if we are on an uptrend, price will continue buying, right? Price will continue buying. And if you're on a downtrend, price will continue selling. Right, this is known as what? The impulsive wave. This is famously known as what? As the impulsive wave. So let's just tackle them again. There are three different types of market structures that we have dealt with. The first one is a swing structure, which refers to our highs and lows, right? Our higher high plus our higher high and our lower high. We are going to be referring them to as what? As our swing highs, and then our lower lows plus higher lows, we're going to be referring them as our swing low, right? And then we then spoke about a substructure. A substructure occurs when price goes against the overall direction of the market. This means that every time you're on an uptrend, price will definitely be what? If you're on an uptrend, giving you a temporary sell. If you're on a downtrend, giving you a temporary buy. Don't look at the word temporary, which means it's not a long term. It's something that happens for a short space of time, and then it will stop, right? It is famously known as a correctional wave, pullback, or retracement. And then the minor structure occurs when price now takes the overall direction of the market, right? This means that if you're on an uptrend, price will start and continue selling. And then if you're on a downtrend, price will start and continue selling, right? Uptrend we buy, downtrend we sell. And then it is famously known as what? Impulsive wave, right? So for example, of an uptrend, right? So our highs, like I said, you should firstly look at this. Our higher highs, which means that this one, we're going to call them what? Our swing highs, right? This is going to be our swing high, and our swing high. And then the lows, this is going to be our swing low, our swing low, and then let me just put this here. And then this is going to be our swing low, right? So these are our swing points, right, within the markets. And then now coming back to a substructure, it occurs when price goes against the overall direction of the market. The overall direction of the market is what? It's a bullish structure. And then this here, it's a temporary sell, right? It's a temporary sell. So this makes what? So this makes this level what? This makes this level a substructure. So which means here also we're anticipating what? A substructure, right? We're anticipating a substructure, right? So this is a substructure, and then a substructure. And then the minor structure is the one that moves price to its overall direction, right? So it means after the substructure is done, we will then anticipate what? We'll then anticipate a minor structure, which means price will then move towards its overall direction, which means that this is our minor structure, right? Minor structure, minor structure. And then also here we're gonna have what? A minor structure. So now to make things simple and straightforward, what this means is that what the market will be doing is that it will be giving us what? An impulse, correction, impulse, correction, impulse, correction, impulsive movement, right? In like simple terms. It's an impulse and a correction wave, right? An impulsive wave, it's the one that takes price to its overall direction. A correctional wave, it takes price to its opposite direction, right, of the overall direction of the market. And then moving on, like I said, it's what? It's minor, sub, minor, sub, minor, sub, minor. And then how does this help you as a trader? This helps you as a trader because of you need to be able to know where you are, right? Where you are. What type of structure are you in so that you can look for those type of opportunities? For example, you cannot look for selling opportunities on the minor structure, right? And then you cannot look for buying opportunities on the substructure, right? These are two very important things, which means on a substructure you sell, on a minor structure you buy, sub you sell, minor buy, sub sell, minor we buy, right? So it is very important for you guys to understand what type of structure you are in so that you can be able to know where you are going to be going, right? So that's the importance of what? That's the importance of market structure. Okay. And then a downtrend, on a downtrend, what is it that we have? We have what? Our swing high. This is our lower high. Then our swing high, and then our swing high here, and then this will be different as what? As our swing low, right? Swing low, swing low, swing low, and then a swing low here. And then a substructure, come and check. A substructure on an uptrend will be what? A temporary buy. What is a temporary buy? It's this guys here. Right. This is what referred to as what? As a substructure. This is what? A substructure. Substructure here, and then another substructure here. And then the minor structure will be what? The one that takes price to its overall with the overall direction of the market. So this will be what? The minor structure. Minor takes price to its overall direction. So this will be our minor structure here, and then our minor structure here. Right. So in other words, as I've informed, is what? It's a correction, impulse, correction, impulse, correction, impulsive movement, right? So which means now it's a sub, minor, sub, minor, sub, minor. Which means now on a substructure, we look for buying opportunities, minor structure, selling opportunities, sub, buy, minor, sell. So which means the sells will always be long, like they'll always be impulsive to the downside, right? But the minor, the sub will always be like short, the buys will always be short, right? The buys will always be short. So does it make sense, guys? Does it make sense, good people? Okay. Okay. So now let's move on to imbalance and supply and demand. Balance and what? And supply and demand. Right. Imbalance is a gap. Right. Imbalance is a gap left by a price that needs to be refilled. Right. Imbalance is what? Imbalance. Balance is a gap left by price. Left by price. Right. That will later be refilled. Right. So that's what we call an imbalance. It's a gap. Right. And then within the gap, there is what we call the candlestick formation. Right. The candlestick formation, we're going to have a candlestick A, B, and C. Right. C, B, and A. And then the gap is going to be in candlestick, B. Right. That's where you're going to find what? That's where you're going to be able to find your price gap. That's where you're going to be able to do what? To find your price gap. So now, just to tackle the chapter of imbalance, so let's have a bullish imbalance example. And then we'll then have what? A bearish imbalance example. So most of the time you hear people telling you about FVG, price efficiency. That's the same thing as imbalance. So bullish meaning that it's on an uptrend, right? So let's say you're on an uptrend like this. And then within the low, you have candlestick A, candlestick B, and then candlestick C. And then we have one last here. Right. So this is candlestick A, this is candlestick B, and then this is candlestick C. Then let's call that just a normal candle. Okay, so candlestick A, B, and C, three candlestick formation. Like I said, the gap will be in candlestick B, right? If you take the wick of candlestick A and then the wick of candlestick C, the bottom wick of it, right? The low of it, actually. Can you see that there's a gap in between here? Right, this gap it's referred to as what? As imbalance. This gap here is referred to as what? As imbalance. Right. This gap is referred to as what? It's referred to as imbalance. Right. So when we have this gap, like I said, price has to come and refill the imbalance, right? Which means it has to come and close this gap. So by closing it, just printing other candlesticks that close that space and then push to the upside after that. Right. That's what we refer to imbalance fill. Right. And then now our demand or supply, right? Every time you're on an uptrend, you're going to look for demand areas. right? You're always gonna be looking for demand areas. What does this mean? This means that your demand will be found as the bearish candlestick on candlestick A and B, right? It will be what? A bearish candle. Right, it's going to be found in candlestick A or B. So hence, if we have this guy here as an H4 time frame, you'll then go to your 15 minutes time frame, right? Right, you then go to your 15 minutes time frame or 30 minutes time frame, any small time frame. Let me just say go to your small time frame. Small time frame. And then you'll then look for that bearish candlestick. And then that bearish candlestick there, you're going to identify it as what? As your demand area. You're going to identify it as what? As your demand area, which means what is it that you're anticipating within the market now? You want price to come fill the imbalance, right? After filling the imbalance, it will then tap into your demand area and then push to the upside of the market, right? And then this means that if there is no imbalance, there is no demand, right? You should always have your imbalance above your demand area, right? So that's something that is very, 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 very important, right? Okay, so moving on, whenever you find yourself in a situation where, as a trader, you find a lot of buying candlesticks like this thing here is called what? Bullish momentum. So this helps price to come back also when you have a bullish momentum, high strong bullish momentum. It helps price to retrace back. And then now a bearish example, right? A bearish example, candlestick A, candlestick B, and then candlestick C, right? And then we're gonna have the lows, right? See the low of A and the high of C create what we refer to as imbalance, right? So this area here is called imbalance. And then this means that it needs to be filled. Like I said, what you're going to do after that, to identify your supply area, is that you are going to go to your smaller time frame, go look for a bullish candlestick here. So here you're going to look for a bullish candle. I'm going to look for a bullish engulf actually. Going to look for a bullish engulf candlestick in between this area here. So once you found the candle, you're going to have this area here as what? As your supply area. Going to have that area there as what? As your supply area. Right? This is going to be our supply area. So like I said, a bearish movement like this is normally referred to as what? As a bearish. Okay, sorry about that, guys. I'm having, I think the rain is coming now, so hence why the network is starting to become bad. But yeah, regardless, right? Like I said, every time you look for this. So the word engulfing, even here, the word engulfing, right? So a bearish engulfing means that it's a bearish candlestick engulfed by a bullish candle, right? It's a bearish candlestick engulfed by a bullish, right? That's what you call engulfing candle. So you're going to identify this as what? As your demand. Same thing with that one. It's going to be what? A bullish candlestick engulfed by a bearish, right? That's what you refer to as our supply and demand. Does it make sense, guys? Does it make sense? Imbalance and supply and demand. Okay, so moving on to our supply and demand. So this is the last chapter, supply and demand and temporary areas. Right. So supply, it normally refers to people selling products at a higher price. Right. If you are a supplier, you want to sell products at a higher price so that you can make profits. And a demand are the people that are looking forward to buying the product at a lower price. Right. So which means the other one will be selling a product at a higher price. I wouldn't be buying it, but I'll only buy it when it's cheap. Hence why everyone waits for Black Friday. So yeah, moving on. Moving on, right? On the topic of supply and demand, right? We are going to be talking about three key levels, right, of supply and demand, which is what we refer to as our premium area, discounted, and equilibrium. Discounted area. So a premium area is where supply is active, right? And then equilibrium, this one, that's where supply and demand they're equal. And then we have what you call RR, price will react and reject, right? And then the discounted phase of the market, discounted phase simply means that that's where demand is active, right? So what this means is that every time you're on the premium, right? And then it's only active where on a downtrend, because that's the only trend we're selling in. Then it's only active where on an uptrend. That's where they're only active. So this means that every time you're on a premium area, right, on a downtrend, that's where you can only sell. And then, which means if you're on a premium area on an uptrend, you cannot sell. And then every time you're on the equilibrium phase, price will react and reject. It's where supply and demand are equal. This means that me as Tumelo and you as the customer, I'm willing to sell you a product at this cost price, and you are willing to also do what? Buy the product at that cost price. Is the midpoint, right? And then the discounted phase, that's where you are looking forward to buying the product from me at the lower price. Okay, and then that's where what? That's where that's where demand is active, and then it's only active on an uptrend. For example, okay, also there's what you call a range. A range, right? A range, right? This occurs when price is trending in between a high and a low, a swing high or a swing low, whatever you want to call it, or a low and a high, right? It doesn't matter. So see that you're on an uptrend, right? You have what? You have a swing high. Then this will be a swing low. That will be your swing low, right? And then this will be your range from your high to your low. And then this will be your range from your high to your low, right? This is what you call range, right? From your low to your high on an uptrend, from your low to your high. And then let's use this range here because that's the one that I want us to talk about. And then this is what we refer to as what? The premium area. Okay, let me just do something. Let's say it as premium, right? Premium area. And then this will be the discounted, equilibrium, which means it's half of this trend, right? Right, this will be the equilibrium, and then this one will be the discounted area, right? And I'm going to use this story here of 10, 5, and 1, right? So like I said, it's an uptrend, which means you're looking for buying opportunities where on the discounted phase of the market when price is cheap, right? Anything that is above 5, right? Above 5, it is considered as what? As expensive. And then everything below 5 going down, it is expensive. It is considered as what? It is as cheap. So which means if you find yourself in a situation where you're entering the markets at the equilibrium phase, this becomes invalid, right? You always want to take your opportunities within the markets where at the discounted level. And the discount is only active from 5 going down, not above 5. Hence why I said that everything that is at the premium area on an uptrend, you do not do anything to it. So now, what is it that we spoke about? We also spoke about that when price is at the equilibrium, when price is at the equilibrium, you'll see normally a consolidation, or you'll see a consolidation within this area here, right? Which will cause a reaction and rejection that will bring price to the downside, right? When price comes to the discounted, there's only one thing that price is after: the imbalance and what? The demand area, right? And the demand area. So which means now price will come tap us in, go up, play around the equilibrium, and then it will go take that high out. Do not look for any selling opportunities here, guys. Please do not. I repeat, do not look for selling opportunities on an uptrend, regardless of you see a big imbalance here. Do not do that. You'll take losses, they will affect you. You'll think that you're not a good trader or whatever. Do not do that. Please. Right? A tap into a demand, a push, hold that buy till it takes that high out. Right? And then for a downtrend, it's also the same situation. We have what? Swing low, and then we have our swing high here. We have our swing high and then our swing high here, right? And then we have what? Our range of our low and our high, from our high to our low, right? This means that we're going to have what? This means here you're going to have what? This means here you're going to have the premium area, right? And then here you're gonna have the equilibrium area, not this one, the equilibrium area, and then here you're gonna have the discounted area. You're gonna have the discounted area here. And then what does this mean? The same thing, it's 10, 5, and 1, right? Every time price comes to the equilibrium, there is a play around before they impulse to the upside. What is it that we impulse into? We impulse into a supply area. A supply area that has what? That has imbalance, right? We are proceeding to a supply area that has imbalance. And then we're going to have a drop after that. Equilibrium, expect price to play around and then go take the low out. Like I said, no buying opportunity should be expected within the discounted area, even the premium area. Here we only look for one sell and then we go down with price. Does types of structures, guys, make sense to you? Does types of market structure make sense? I mean, supply and demand. Sorry about that. Types of structures and supply and demand, do they make sense to you? And then moving on to the second last chapter, which is temporary areas. This one is simple. A temporary high, it is normally referred to as SMC people as what? As a liquidity, right? I don't use those terminologies, right? When you say something is a temporary high, we're simply saying that, see, when price is impulsing to the upside, right? And then it leaves a high before tapping into your demand area, I mean your supply area. Let's say this is your supply area. This is what you refer to as what? As a temporary high, right? Then price will take it out, tap and go down. It's normally called inducement or a liquidity. Same thing with the bullish structure. A temporary low will be found before price taps into your area of demand, right? This is a temporary low, price will come, eliminate it, and then push to the upside. Why am I teaching you this? Because I use them a lot. I don't want you to be confused or asking me what are temporary, what. It's just, you see the word temporary, it shows that that thing is not there permanent, right? So, yeah. Does it make sense, guys? Yeah, I've been talking. Okay. Okay, so now moving on, let's talk about how to apply the setups, right? How to apply the concept, right? So what we normally do within the markets now is that we start from our daily and 1 week. See, I'm telling you, we start from our daily and 1 week. Eh? See someone sending me something and I go check it, daily and weekly doesn't correspond with the setup that he sent me, then I have a problem. What do? We want to know our trend. And what else do you want to know? You want to know the type of structure. Right? And then what else do you want to know? We want to know, we identify actually on a daily time frame. Oh, on a D1 time frame. We want to do what? We want to identify our daily supply or demand. Right? And then what is that you're gonna do after that? Go to your smaller time frame, H4, so 30 minutes or 15 minutes and 15, and trade the type of structure. Presented on a daily structure, right? So moving on. So let's say we are on a downtrend. So this is a daily or a weekly. Let's say this is a weekly. Right? And then here we have the daily structure. Let's say this is the daily structure. Right? What is it that you've identified on a weekly? It's your what? Your supply and the structure. You know that you're on what? You're on a substructure, right? Which means automatically you have this on a bigger time frame also, on a daily, and this also, right? Which means when you go to your 4 hour or you start thinking about 4 hours, you're only going to focus on this area here, the substructure, right? Which means when you get to the substructure, you're going to find what on a 4 hour time frame? This, right? That's what you're going to find. Which means now, what is it that you've seen? You've seen that probably they have what? We have imbalance here, and then we have a demand here. Which means we have what? We have a demand here. On like day, on 4 hour, 1 hour, whatsoever time frame. And then what is it that you're gonna look for? Entry from here and really to the upside. Where are you? Which means you're gonna keep on buying on a 4 hour or your 15 minutes, right? Till you reach your weekly supply. Once you've reached your weekly supply, this means that your daily will also be here. Now you're switching from a sub to a minor, right? Which means now you should start looking for selling opportunities. The same approach. How is it going to be? Let's redo it. We're going to have something like this. Let me make them small actually. So this is your weekly. Then this is your daily, right? And then your 4 hour gonna be this. This is going to be your 4 hour, right? So what is it? It's your supply area, which was tapped even here on a daily, which was tapped. Now this here, the minor structure is this, right? I've told you guys previously that if you want to change the structure of price, right, you use what? Two trend lines, two touch of the trend line. For example, for this one, can you see there's the first point, second point, right? You have a trend line like this. If there is an untested demand here, I mean supply, price will have to come, tap into it, and then go down, right? Same thing with a downside movement. If you have a demand area like this on a weekly, and then you'll see on a 4 hour, you can have something like this. If you find it, look for this, then a push to the upside. So it's similar to those that call it charge, but now we use a trend line most of the time. Okay. So that's what you're gonna find on these time frames. Which means now when you go to your 15 minutes to 30 minutes, right? You're going to find yourself in a situation, you're gonna start from here. right? You're gonna find yourself in a situation where you have the same thing actually. Let's say you have the same thing like this. And then that drop, and then a rise to here, then you're gonna want that push, right? So which means now if you're looking for selling opportunities here, right, it's gonna be the same thing as looking for selling opportunities here. This zone is similar to this zone here, right? Which means now this will be your temporary high, right? This can be reversed as what as your temporary high. It's simple, guys. Hence why I teach you types of structures so that you can know where you are, so that you can know where you're going. I can't emphasize the whole thing like over and over. This is the best session you should have ever held. This is the first time I'm doing this. Same thing with this one. Weekly, right? And then daily. Right? We know that this is our daily demand, and then this is our weekly demand. Right? Simple. That's one thing we all know. And then what comes after this? It's our smaller time frames, right? We know that this will be what our substructure. I normally don't advise people to trade substructures, right? But you can trade the substructure because of waiting for price to come to a weekly demand can take you weeks, right? Which means now within this area here on a 4 hour, what is that you're gonna have on a 4 hour? You're gonna have something like this on your 4 hour time frame. To touch, a trend, a break, and a supply area. And then come the smaller time frame, you start from here to there, you can have something like this. Then you're done. You have your entry here. Mind you, everything is driven by imbalance. There's imbalance here. 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 Let's go check the charts. I normally like to use US data because it's the most simplest to trade with supply and demand. And I gave you guys a homework. Some of you guys failed the homework. Let's redo it. Let's remove all drawings. Start from a week. Oh, Gemin 80. Gemin 80, guys. Oh, I saw something beautiful on Gemin 30. We have 1 week. Right, Gemin 30. See Gemin 30, we have what? Efficiency here. Right, momentum. We have another momentum here, and then we have another momentum here. Right. So this one is not yet filled. This one is not yet filled. The current filled one is this one. Right. That's on a weekly structure. That's on what? Weekly structure. So we're gonna focus on this one. So if we cut price here, right? You can see that there's what? There's momentum here, right? There's momentum. And then what are you gonna do? 1 day time frame. Okay, on a 1 day, you can see that there's no like clear, what do you call this thing? Demand area. So it's this one here, right? But it's a bit far. Okay, let's go check on other time frames. Okay, we have this one. Engulfed proper candle on a weekly. That is too big. Same thing, 18 hours. 18, let's go for 9 hours. It's fine. Just want to give you guys an example of what I'm talking about. So price does what? Times taps is in. Okay, here we can see that okay, it went straight to like this area here. I'm not sure. Let's check actually if there is like a proper demand or supply within that area. Yeah, there is. This is the one. Cause price did what? It engulfed to the upside here. Price really to the upside. Yeah. So this is the first movement with imbalance. Right. When it tested this low, it didn't tap into our area. So which means the imbalance is still valid. And so it came straight to this one. When you go back to our daily time frame, if identified our zone, then hence why tap here. Right. So you have a setup like this. Hence why we expect what? This. Which means you can't bother yourself to start saying that, oh, Tumelo, did you see this imbalance here? Oh, Tumelo, did you see this momentum here? Right? You can't tell me any of those things. Yeah, you can't tell me that. These things are invalid because of we have a daily tap, which means all these guys here. You see what price does? Take them out. You hold the buy till you take profit. The only thing you do is to look for what? Keep looking for buying opportunities till you go hit this high here. Another thing, an A setup. Forgot to tell you guys about this. An A setup. How do you look for an A setup? An A setup has a consolidation, right? It has a consolidation. It has a temporary low. It has the imbalance. It has the consolidation. It has the temporary area. Right? And then it has what? A demand or supply. Then the trend is very important. Firstly, or even lastly, imbalance, consolidation, temporary area, demand, a high that needs to be taken out. Then you know that you plug your what? Premium, equilibrium, and discounted. Any entry below this area here is valid. That's what we call an A setup. Same thing with him. Right? Your momentum or imbalance, your consolidation here. Your temporary area, and then your supply or demand. Then put your gun box to check if everything is accurate. Does it make sense, guys? For him on a weekly time frame, imbalance, consolidation, temporary low, right? And then you're gonna look for a demand here, which means go to your daily time frame and the type of structure is a sub. Right, so this is our demand. So which means now you should, hence why I don't advise people to trade substructures. Right? Because if you look for a sell here, you're being taken out. Not nice. So yeah, you're still gonna look for that drop to this area here. Then a push. So hey guys, I'm gonna give you guys homeworks and I'll ask you guys to do some things for me. Watch the session and yeah, thank you very much for attending the session and goodbye. Oh wait, I forgot to ask you, like, did you guys enjoy this one? For some of you guys, it's your first time with me here. Did you guys enjoy this session? Okay. Go mentorship, then that's it. You can see over here 11 clients, winning team. Okay, let's go chop.